Welcome, my dear students, in our course International Financial Markets. Today, we will present some topics related to categories of international bonds, and we will start with the first category. We classify international bonds based on tax. Two categories or two types of international bonds based on tax. The first, taxable bond. In case of taxable bond, this bond interest income is taxed as a part of bondholder's total income. Yes, in this case, the bondholder pay a tax from the earn of this bond. The next case, non-taxable bond. In case of non-taxable bond, we can call tax-free or tax-exempt. This bond is exempt from any paying of taxes. In general, municipal bonds are tax-exempt or free of any tax if the bondholder, the municipal bondholder, no payment for any tax because this bond is tax-free. But on the other hand, in case of corporate bonds, taxable bonds. Generally, when we talk about the USD bonds, this is the type or are taxed or categories of taxed bonds because the bondholder pay a tax. Maybe USD bonds are taxed at the level of federal, but tax exempt or tax free at the level of state and local levels, or when we talk about municipal bonds. Now, how we can compare between two categories of bonds, taxable bond and non-taxable bond. We will use the formula equivalent tax-free rate equal taxable rate 1 minus T. T small in our case equal the marginal tax rate. Marginal tax rate. In our problem in page 132, problem 9, two types of bonds. Say in our problem you want to invest 10,000 US dollar in bonds, two options or two bond issues available in the market. Municipal bond with coupon 4% and taxable corporate bond that has the same credit rating. This is very important. Same credit rating equals the same risk. With the coupon rate is 5%, the marginal tax rate is 25%, and which one you would choose if two bonds are identical in all other factors. Okay, for the first time, when we compare between municipal bond tax-free, no tax, but coupon rate 4%. The second option, invest in taxable corporate bond with a higher coupon rate 5%. So for the first time when we compare between the coupon rate in case of municipal bond 4%, the coupon rate in case of corporate bond equal 5%, but take care about the marginal tax rate. Marginal tax rate equal 25%. In case of municipal bond, no problem, because this bond tax-free, no taxes. But we need to evaluate the net return or equivalent tax-free rate in case of corporate bond by the last formula, which is equivalent tax rate equal 5%. 5% refers to the coupon rate in the bond or the corporate bond. What about 25%? 25%, this is the marginal tax rate. The net return, and we can call that equivalent tax-free rate equals 3.75%. So when we compare between the coupon on municipal bond 4% higher than the equivalent tax-free rate for corporate bond, which is 3.75%. So we recommend that to invest in the municipal bond with a net return by 4%, but the corporate bond net return equals 3.75%. The next category, we classify international bonds based on security. Secured bonds and or versus unsecured bond debentures. The first category, secured bonds. In case of secured bonds, we talk about collateral that backed the bonds issue and ensures the ability of issuing the company to repay the face value back. We talk about collateral. This collateral make the bond secured with minimum risk. For example, this mortgage bonds. The mortgage bonds is an example for secured bonds. But suppose the issuing corporate fails to payment or make a payment as scheduled, secured bond have the right to liquidate the asset because this is bond secured. So this is the right to liquidate the asset used in collateral. Say any fixed asset. This fixed asset considered a collateral for the secured bond. For any problem in the issuing corporate, the bondholder of secured bond have the right to liquidate the asset used as a collateral in order to get paid. This category we can call mortgage bond as example for secured bonds. Some bonds are considered secured because their indenture include sinking fund provision. What do I mean by sinking fund provision? In this case, sinking fund provision, this is account managed by a bank for the purpose of repaying bonds. This issuing company makes annual payment to the trustee who then uses the funds to ensure the payment. So, in this case, this is another example for collateral. We talk about sinking fund provision. Sinking fund provision by bond trustee in general, we talk about the bank. In all cases, this is secured bond. Secured bond because we talk about collateral in case of fixed asset or in case of sinking fund provision by a bank. What about the next case, unsecured bonds? Unsecured bonds or debentures. Debentures are long-term bonds without any collateral, without any asset collateral or any sinking fund provision. This is the inverse case from secured bonds, debentures. They are backed only by general creditworthiness. we talk about the general credit worthiness of the issuer. Say corporate A had a good credit worthiness in the market. This is the only collateral for the bondholder. We talk about credit worthiness for of the issue. Debentures have lower priority than secured bonds if the firm defaults. In case of liquidity, in case of liquid the corporate or the assets, the first priority for secured bonds and then unsecured bonds. So we can talk about debentures. The next category, we talk about classification of international bonds based on claim priority. Based on claim priority. Two types or two subcategories. Senior bonds or non-subordinate bonds, and number two, subordinate bonds. We can call subordinate debentures. What about the senior? In case of senior bonds, bonds where the holders have the priority in getting paid in case of issuing company is liquidated. In case of liquidate for the corporate, the senior bonds holders, the first priority to getting the paid or the face value of bonds. So we can talk about subordinated bonds, non-subordinated bonds. The next case or the next classification, we talk about subordinated bonds. In case of subordinated bonds, the holders have lower priority claim in case of default or liquidation for the corporate. So the subordinated debt holders are paid only after senior. The first, the corporate or the issuer of the bond pay the value for senior bonds holders and then to subordinate bonds holders. Because subordinated bonds unsecured, we can call subordinated debentures. We compare or combine between debentures with no collateral and subordinate priority number two after the senior bonds holders. The third, we can classify international bonds based on the right to redeem. The right to redeem. Two rights. We talk about two rights in case of callable bonds and putable bonds. In case of callable bonds, this bond with the call provision. Call provision is a condition in the bond indenture that give the issuer the right to redeem the bond before maturity at a specific future date at a given price, which call price. So, in case of callable bonds and putable bonds, we talk about a very important point. In case of callable bond, the issuer had the right to redeem the bond before maturity. In case of putable bond, the investor or the bond holder can or have the right to redeem the bond the same before maturity date. So, call price generally higher than the bond's face value. In case of callable bonds, call provision, this is the right to redeem from the issuer for the bonds before the maturity date. Call price, in general, call price higher than the bond's face value. Suppose the issuer face value equal 1000. If the issuer try to call the bond to pay greater than 1000, to pay greater than the or higher than the bond's face value. The next, call premium. In case of call premium, this is the difference between or the gap between bond's call price and the face value or par value. This is call premium. In our example, we talk about face value with $1,000 and call provision, which is or call price maybe 1,200. So the premium call premium in this case, the difference between or the gap between face value and the call price in our example equal to $100. Call protected. Mainly, we talk about all bonds and the first or the early stages call protected. Maybe, suppose we talk about bond with life 5 years. Generally, mainly in 3 years or the first 3 years or 2 years, the bond call protected. The issuer cannot call the bond at the first years from the lifetime of the bond. Okay, when we talk about reasons, why the issuer call the bonds? Two main reasons. Number one, as a protection against declining interest rates. Number two, to keep chances of taking advantage of improved credit rating in the future. So in two cases, we talk about the corporate or the issuer try to compare between interest rate and the payment. Number two, we talk about the credit rating for the issuer in the future. Note, the bond should be called only if the present value of the bond's future cash outflow is greater than the call price. This point, suppose corporate A issue bonds with lifetime 5 years, and the bonds have the right to call in the indenture. So in this case, the corporate compare between present value of cash outflows and the call price. In our problem, suppose in our problem number 10, our problem number 10 in page 136, we talk about 5-year bond lifetime. 5-year bond lifetime. But 2 years ago, so now we are in the year number 3. Mainly, how many years? 5 years bond life. In our problem, we talk about 2 years ago. So now we are in the year number 3. ABC Corporate 5 years bond with face value $1,000, 8% coupon rate. That is callable bond. So the issuer APC has the right to call or redeem the bond before maturity because it's callable bond. But remember, this is protected only in the first 2 years. So that is callable at the beginning of year 3. From year 3, year 4, year 5, you can call as the issuer for this bond, you can call the bond. For $1,050. The market interest rate 2 years ago was 8%. 2 years ago, we talked about the protected time. Protected time. Now, at the beginning of year 3, as we started in year 3, the market interest rate 6% and expected to remain 6% for the rest of the life or the bond's life. We compared between should APC call the bond or not. Now, we need to calculate the present value. The present value, BV. Present value, we started from year 3. So the lifetime for this bond, mainly 5 years. 2 years protected, cut. We started from year 3 as year 1. Year 4 as year 2. Year 5 as year 3. Because the right to call the bonds started from year 3. And this bond protected only in year 1 and year 2. So this is 80. 80 equal coupon rate. Coupon rate in our example equal 8%. Coupon rate equal 8%. 8% times face value or principal, so equal 8% times 1,000 equal $80 in year 1. 1 plus interest rate. Interest rate 6% from year 3. So the power equal 1. The same coupon equal 80. 1 plus 1 plus interest rate 6%. But the power equal 2 because we started with the year 2. Year 1 power 1, year 2 power 2, year 3 power 3. The same 1 plus 6%, 1 plus 6%, 1 plus 6%, but the difference in the power. Power 1, year 1, power 2, year 2, power 3, year 3. Because we considered from year 3, this is the started year in the callable bond. Year 4, year number 2 in the callable bond. And year 3, this is the last year in the callable bond. At the last year, in the lifetime, this is year number 5. But in case of callable bond, we talk about year number 3. The issuer pay face value plus the coupon rate. So the result equal $1,053.46. This is present value. The issuer will pay present value equal $1,053.46. Present value for cash outflows from year 3, year 4, year 5 in the lifetime for this bond. But what about the indenture price for call? Equal 1,050. Because present value of future cash flows, present value of future cash flows is greater than the call price, the bond should be called. This is from the issuer or the corporate view. Because the present value of future cash flows is greater than the call price, the bond should be called. Suppose the same call price 1,050, but the present value of future cash flows equal 1,040. In this case, shouldn't be called. This bond shouldn't be called because if the call price if the call price greater than the present value of future cash flows, this bond shouldn't be called. Generally, when we talk about call risk and reinvestment risk, in case of call risk, this is uncertainty about the future cash flows from the bond introduced by the call provision and calling the bond subjects bondholders to reinvestment risk. Maybe when we talk about the call, the right to call the bonds, or in the right to put the bonds, in all cases, no uh, plans or no plans from the issuer in case of callable bonds and in case of investor in case of putable bond. So in case of putable bond, this bond in the indenture for or the bond indenture give the bondholder the right to redeem the bond before maturity with the put price. Mainly when we talk about the bond, in case of callable bond or putable bond, maybe in all times you need to compare between the present value and the call or put price. The present value and call price, the same present value and the put price for investor. In the case of potable price or potable bond, we talk about investor. Mainly, there is trade-off. We can call the potable bond and callable bond zero-sum game. The issuer when there is a loss for the investor. The next case, we can classify international bonds based on convertibility. Convertibility, when we talk about if you can convert or the indenture of this bond convert the bond to common shares and or for bonds another bonds from issuing corporates. But let's start with non-convertible bond. This is a general case. Non-convertible bond. In case of non-convertible bond, the bond doesn't offer its holders the option to convert into shares. No convert into shares or common shares. Mainly, this is the general case. Most bonds are non-convertible. Most bonds are non-convertible to any common shares. The next, convertible bond. In case of convertible bond, this is exception because the corporate bond give the holders option to convert the bond into stated or specific number of shares. In case of convertible bond, the right for the bond holder, to convert the bond into specific or stated number of common shares. This share or this call conversion ratio. Conversion ratio, this is the ratio to convert the bond face value into specific shares. So the rule equal conversion ratio equal face value of convertible divided conversion price of common stocks. CS equal common stocks. So the conversion ratio determines how many shares of common stocks can be converted from each convertible bond. Suppose the ratio equal 1 to 30. So 1 pound converted to 30 common shares. What about conversion price? Conversion price of common stocks. Conversion price equal face value of convertible divided conversion ratio. Divided conversion ratio. When the converter or when a convertible bond is the first issued, the conversion price is much higher than the price of the common stock to which be converted. So at the beginning of the life of converted bond, the conversion price should be greater than or higher than the price of the common stock which be converted. To eliminate any incentives for convertible holders at the beginning of the bond. Conversion ratio we can call conversion ratio or conversion value. Conversion value equal conversion ratio multiply price. Conversion ratio multiply price. What about the conversion price of common stocks? If you need to calculate the conversion price of common stocks. Conversion price of common stocks you will replace with conversion ratio. Conversion price of common stocks equal face value of convertible divided conversion ratio. Okay, convertible bond, we need to calculate the conversion premium. Conversion premium. At the beginning, when we compare between the conversion value and face value. Conversion premium equal, this is the change in the bond price. Bond price divided which maximum? Conversion value or face value? Divided the same maximum, which is conversion value or face value. In case of conversion value greater than face value. Conversion value greater than face value. So the premium equal bond price minus conversion value divided conversion value. New minus old divided old. In case of conversion value lower than face value, so we will replace that the bond price minus face value divided face value. Now we can present problem 11 to discover the difference between all cases. In page 142, convertible bond in our textbook 142. 2 years ago, FMI Corporate issued 5-year bond with face value 1,000 US dollar, convertible during the first years into 40 shares. Into 40 shares of common stocks. 40 shares, 1 to 40. 1 pound equal 40 common shares or common stocks. At the time of issue, the bond was trading at par and the common stock was trading at $20. At year one, from the lifetime of this bond, the price of common stock equal market price equal 20, and the bond trading at par with the same value 1,000. FMI common stock sells for $30 while convertible bond sells for $1,260. So we compare between two cases. at the first time or time of issuance, bond sell at par, 1000, and the common stock market price equal 20. Currently, currently when we talk about year number three, FMI common stock sells with $30, so the market price of common stock increased from 20 to 30. The same, the convertible bond price increased from 1,000 to $1,260. Okay, what about the requirement? Number one, what the conversion price of this bond? Conversion price of this bond. To calculate the conversion price, number one, the face value divided the conversion 40 shares. 1000 divided 40 equal $25. Conversion price equal $25. Now, when we compare between $25 with the price of common stocks at the beginning, $20. $20. This is the price. Number two, what was the conversion value of this bond at the time of issuance? Time of issuance. We talk about conversion ratio, this is 40. What about market price at the beginning? $20. Market price at the beginning equal $20. So the conversion value equal conversion ratio 40 common shares multiply common shares or common stocks, the price of common stocks in the market equal $20. So the conversion value equal $800. We know that the conversion value at the beginning or at the time of issuance equal $800, but the face value equal $1,000. Number three, what was the conversion premium of this bond at the time of issuance? Okay, at the time of issuance, this is our note that the conversion value equal $800, lower than the face value or par value, which is $1,000. So the premium equal bond price minus face value. Why face value or par value? Because we use a par value 1000 greater than the conversion value. 1000 minus 1000 divided 1000 equals 0%. This is 0% at the time of issuance. Why 0%? Because the face value or par value 1000 greater than the conversion value. Number D, what is the current conversion premium of this bond currently? We talk about currently. Currently, we will use the market price at year number three, which is $30. $30. So this is constant conversion ratio, constant with 40 common shares, 40 common stocks. 40 common stocks multiply with $30, the conversion value equal $1,200. At this case, conversion value $1,200 greater than the par value. Par value equal 1000. This is constant. So the conversion premium. Now we will replace or we will use the conversion value or accept or replace the conversion value with the var value. So the premium equal bond price, market bond price equal 1,260 minus conversion value we calculated with 1,200, so the conversion premium equal 5%. Conversion 5%. This is conversion premium from or at the beginning of year 3. We use a conversion value because the conversion value equal 1,200 greater than the par value. The last one, ignoring all other considerations, should this bond be converted into common stocks now? Why or why not? When we talk about now, we mean that we are in the year number 3 because the price equal $30. The price equal $30. So the current market price now in our year number 3, $30 greater than the conversion price $25. So the current conversion value $1,200 greater than the bond's par value 1,000. So this bond should be converted into the common stocks. But we ignore all factors like tax, like risk, like yield, all factors. So we ignoring all other factors, all other considerations. With this, when we ignore all other consideration, yes, this bond should be converted because it's profitable for the bondholder to convert this bond into common stocks. Important notes in our pages from page 140, 141 about the convertible bonds. Number one, convertible bond is considered a hybrid investment because we invest in both fixed income investment and equity investment. We talk about mix between the bond and common stocks because this bond can be converted. The same if the underlying common stock trading below the conversion price, convertible bond trades like a regular bond. The same if the underlying common stock is trading above the conversion price, the bond may be converted to common stocks. In all cases, we compare between the common stock trading above the conversion price or below the conversion price. The next, rate convertible bond and reverse convertible bond. In two cases, we talk about special cases, exception of convertibility. What about the rate convertible bond? Rate convertible bond, some variable rate bonds are convertible to fixed rate bonds until maturity under specific conditions. So we can call any variable rate bond converted to fixed rate bonds until maturity. This is rate convertibility. Rate convertible bond. In case of rate convertible bond, we talk about variable rate bonds. The next, reverse convertible bonds, RCB, reverse convertible bonds. The special case of convertible bonds give the issuer the right to convert the bond into more options into more options. Maybe convert to another bonds, convert to cash, convert to share of common stocks of another company. This is specific, or when we talk about reverse convertible bonds. For example, if a bank issues a 2-year reverse convertible bonds (RCB), it could be redeemed after 1 year for cash or converted into bonds or stocks of a top-rated corporation. You can convert from this bond to another bond for another issuer for another stock issuer for the same category. The next classification of international bonds, we talk about conditionality. Most bonds promise the investors unconditional payment of the interest and face value. So this is unconditional bond. In case of unconditional bond, regular payment for coupon for the face value in the end of the life for this bond. This we can call this is unconditional bonds. This is regular or normal bonds. What about conditional bonds? This is very important. Conditional bonds. Conditional bonds, this is exception from the normal bonds. For example, when we talk about the shorty bonds we can call performance or contract bonds. The second category of this conditional bonds, we will talk about catastrophe bonds, and the income bonds. The first shorty bonds in our conditional bonds, shorty bonds common within construction industry in USA, in UK, and other Western countries. Designed to ensure project owners that contractors will complete the project as a specific time or contract. The issuer of shorty bond may be insurance company promised to pay the project owner, the bondholder in this case, certain amount if the contractor failed to meet the obligation as specified in the contract between the project owner and contractor. Okay, in this case, shorty bonds. We talk about in all conditional bonds, we talk about the insurance and reinsurance corporates. Insurance and reinsurance corporates. Yes, for the first category, shorty bonds, the insurance corporate can pay the bondholder any amount because the contractor failed to meet the obligation. So in this case, the shorty bonds relationship between the corporate or insurance corporate and the bondholder, but especially in the construction industry in USA and UK. So to ensure that the contractors will complete the project as specified in the contract. Based on this contract, we talk about obligations. Obligations for the contractor and the bondholder. So the insurance corporate in all cases when we talk about the major player or the key player in conditional bonds. The next, catastrophe bonds. Catastrophe bonds we can call CAT, C-A-T. Catastrophe bonds, this is a very important bond used in disaster cases. Disaster cases. The first of catastrophe bond beginning maybe after 1992. After 1992, after hurricane called Andrew Hurricane, this is in Florida in USA. So, in case of disaster bond, we talk about the same. The key player in a catastrophe bond, insurance corporate and reinsurance corporates. Say the insurance corporate issue a catastrophe bond with a $1 million. The face value for one bond equal 1,000. So this bond is very short, maybe 3 years, another maximum 5 years. Yeah, maybe 1 year, maybe 3 years, maximum 5 years as a lifetime for catastrophe bonds. So the insurance corporate issue the catastrophe bonds with the investment bank or by the investment bank. The holder of this bond have the right to earn payment or high yield or high coupon rate. Maybe in some cases equal LIBOR plus 20%, 15%, 10%, a greater percent for any normal bonds. Okay, what about the mechanism for the catastrophe bonds? Suppose there is no disaster in the lifetime of this bond. No disaster of the lifetime of this bond. Okay, the bondholder earn the principal and coupon without no problem. But suppose there is a disaster like hurricane, like volcano, like earthquake, any natural disaster. We can call about COVID-19. This is the same natural disaster. We will compare between the costs or the claims for the insurance company and the value of the catastrophe bonds. In our example, we talk about $1 million as a catastrophe bonds. Suppose the costs for this disaster greater than 1 million. In this case, there is a big problem for the bondholder. Bondholder will lose and cannot earn the principal or the face value. But suppose there is the costs of this disaster lower than 1 million. Lower than 1 million, so this is the percent. The bondholder can earn some of principal value, not all the principal value. The major players or the major investors in the case of or the market of catastrophe bonds, we talk about institutional investors, not personal. Institutional investors like hedge funds, pension funds, and all institutions invest in this market. Okay, so repeat again, when the loss of this disaster or the cost of this disaster exceeds or greater than the value or the issuer's obligations, so maybe the issuer cannot repay the principal. The issuer cannot repay the principal or maybe defer the principal, cannot pay some or all the principal to the bondholders. So this category of bonds called insurance linked securities. Insurance linked securities. Insurance linked securities because insurance and reinsurance corporates the major players in this category of bonds. The last one, income bonds. Income bonds, the same example for conditional bonds. In case of income bonds, corporate bonds whose coupon payment depend on the level of corporate income. We talk about the earnings, the revenues. If the earnings are not enough to cover the interest payment of an income bond, so the interest payments are not owed. Therefore, the issuer or income bonds are obligated only to pay the principal at maturity. Their payment of interest depends on their level of corporate income. So, this is the last category of conditional bonds. Based on the income, the corporate can pay the principal. We can make a summary for conditional bonds. In case of surety bonds, this is at specific date. When we talk about construction industry, the insurance corporate make the payment. At the case of catastrophe bonds, so when we compare between the costs of natural disaster and the cost of issuance. When the cost of natural disaster higher than the costs of or the value of issuance for this bond, the issuer maybe pay some or not from the principal, repay some and cannot pay all principal value. In case of income bonds, we talk about this depend on the earnings. If the earning for this corporate issuing the bond covering the interest payment, okay, no problem. But suppose there is a problem, we can talk about percent from the income bond. In all cases, we talk about conditional bonds. Mainly, in case of conditional bonds, we talk about higher risk. So, the coupon rate at maximum. Higher risk because the payment under condition. Under condition in case of surety bonds or contract when there is a problem between the contractor and the issuer. In the case of catastrophe bonds, when we talk about the cost of natural disaster. In case of income bonds, it depends about stable the earnings for the issuing corporates. The last category of the international bond when we talk about credit rating bonds. Mainly, we talk about two subcategories. Number one, IG bonds, IG abbreviation for investment grade bonds. Investment grade bonds, when we talk about the credit rating, minimum, medium, or high. high to medium quality rating or high and medium quality credit rating. Mainly when we talk about triple B or higher by Standard and Poor's institution and Fitch, or B capital double A small or higher by Moody's. B capital double A small 3 or higher by Moody's institution. The credit rating categories of triple A capital, double A, and 1A. So we present the classification of credit rating in the chapter number 1. So the investment grade bonds, we talk about high category, from medium credit rating to high. The risk, in this case, moderate risk. So the interest rate, we talk about moderate interest rate. The last one, junk bonds. In case of junk bonds, we talk about lower credit rating. Lower credit rating. In case of Standard and Poor and Fitch and Moody's for credit rating of these bonds. So, junk bonds provide investors with the high rates of return. Junk bonds, high rates of return because high risk. Our rule, high risk, high return. What about the risk premium in this case? From 3% to 7% in the US bond market above the T bonds with the same maturity. Junk bonds may be the return 3% to 7% above the US bond market above the T bonds. Now we finished our lecture, and now we in page 147 we will complete our lecture time in the discussion and simple questions in Google Classroom. See you in the next lecture, and goodbye.